Application of financial reporting framework. So, financial reporting framework adopts by the management and where appropriate, those charged with governance in the preparation and presentation of financial report statement that is acceptable in the view, the nature of the entity and the objective of financial statement that is required by laws and regulation. So that is what they say is mostly all the financial statement what schedule 3. If they have a listed a public company have based upon the turnover, they need to have a, as per India's accounting policy. Normal gap is enough. So normal account standards enough. If not, they need to follow NDAs. Then what NDAs now they have a schedule, different schedule of balance sheet, profit and loss account, and balance sheet. So normal, this is the normal balance sheet. Then what? If they have a CIBIL, they should have an XBRL report. MC listed company XBRL report should be given based upon the turnover. Then what they need to file MDT7 AOC4. Then what they need to file the annual return. What these are the things that is being under the financial reporting framework. So what the government says as per that rules and regulation, because banking they have a different regulation, a different format of reporting. Insurance they have insurance, they will have different. Banking they different. Insurance, electricity board they have different. So different segments has their own form of accounting. So they need to follow that. So especially they need to follow that. A term fair presentation framework is a fair presentation framework is used to refer a financial reporting framework that requires compliance with the requirement of framework and acknowledges explicit of limit explicit and implicit that to achieve with fair presentation for financial statements. It may be necessary for the management to provide disclosure and beyond the specific requirement by the framework. So they should acknowledge this like we have followed schedule 3, we have followed India. Yes, this is the accounting policy. We have notes to account. They need to give everything. Depreciation is charged based upon this. Amortization is given like this. The value of this stocks are valued in this way, FIFO method or this method, that method. Then you should mention that. Then after how this asset has been revalued, what method fair value, how they given, how the loans has been disturbed, loans has been from current liability, non-current to current liability, what is accounting policy being used, what is how the grant has been received, how the grant has been accounted, how it's a revenue expenditure or capital expenditure, what there is a change in depreciation policy, why the depreciation, there isn't change in the value of the asset, why the change in valuation, everything should be given and they should mention that this is within the framework of the accounting policy. They can cross over it and acknowledge explicitly that it may be necessary for management to depart from the requirement of framework to achieve the fair representation of the financial statement. Such departures are expected to be necessary only the extreme circumstances. Sometimes this may happen. What is that? They have foreign companies. They have subsidiaries in foreign countries. Their country is the accounting policy in that country is totally different. In a current totally different. But there may be a problem of valuating item. Example, if the country, some countries values Bitcoin as a legal currency, they can follow. They can give a currency model. So the country which they operate, they may receive or through a sales they have received Bitcoin. But India, that is a different total policy. You can't be considered as an asset. That is a big question how to use it. Whether the Bitcoin to be classified as a current asset or non-current asset, or even they may buy some tokens. For example, they get NFT. If a art is bought through an NFT, whether the NFT is in cash or whether it is in long-term asset or a current asset, there is no proper classification definition. So in that circumstances, this company have to take some decision. Either they need to consider the expenses, or they need to consider as a current asset, or they need to consider as a non-current asset, or they need to consider cash and cash equivalent. No, that is a problem because this is the things that circumstances comes out. The terms compliance framework is used to refer the financial reporting framework that requires compliance with the requirement of framework but does not contains acknowledgement of A and B. Okay, so they have complied with this. That's it.